Good morning. This is Tom Alexander. It is Saturday, January 20th. This is the weekend update for Monday, January 22nd. And we had quite the week in the U.S. stock indices with the NDX, SPX, and Dow trading vertical to the upside off of Wednesday's low. We are now trading in new all-time highs in the Dow, the NDX, and the SPX. The Russell is an issue. Now, the Russell also began to show some strength on Friday, and we're going to talk about that because it's absolutely critical if this rally is going to continue that the Russell continues to participate. All right, let's take a look at the charts here, and we'll look at that screen. Okay, here are the 4 U.S. primary trading indices. I'm just going to take them one at a time. I'm going to start with the SPX. And, I've been talking for weeks about the importance of this 4,800 level. And we had all sorts of games played in and around this level that's been going on since the end of January. We flirted with it the end of December, flirted with it in the middle of January. Then we had the 3-day, actually 2.5-day dump into Wednesday's low, and then bungee jumped and started the ramp higher. Now we have we're trading in new all-time high ground in the SPX. We're above that 4,800 level. I think getting above that 4,800 level was part of the reason for the ramp on Friday. Probably set off out just, rote trading and algorithms above that level. The levels, by the way, that I'm showing on these in this video you can find on the website. You can go to alexandertrading.com, click on weekend update. It's free, and you can see all these charts. You can see some of the verbiage from this video. Also, by the way, if you find value in this, if you would like, subscribe and make comments. It would be very helpful for the magical algorithms that drive traffic to the site. So that would be very helpful and be very much appreciated. Okay, so it's pretty simple now, really. The general guideline when you have conviction like we had off of this level, and in particular on a given day. Now this happens to be 3-day conviction, but let's just talk about Friday. Friday was an incredible ramp, and now if it's going to continue, ideally you won't retrace 50% of Friday's range. If we start retracing 50% of Friday's ranges, particularly if it occurs in all of the indices, then that makes this really suspect. And I'm going to talk about that in just a minute. We're at one of these inflection points from a technical condition in terms of price action versus the technicals, where I think we almost have to see either continued rally immediately, or we're putting in some sort of a top of relative significance, and I'll talk about that. But now let's again back to where we are. The SPX is trading in new all-time high ground. The NDX, of course, is trading in new all-time high ground. The institutions cannot get enough of these 7 stocks. We have a gap up on Thursday. We had a gap up on Friday. Now it's off to where no man has been before, straight up. Now, you've heard me say this before. I do expect under normal conditions, and this isn't a normal condition, and I'll explain more about why it's not in just a minute, and I'll show you that clearly. In normal conditions, when you have this much upside momentum, you're expecting follow through. Now, we may get that. If we don't, we're going to have a pretty dramatic retracement. I'm not predicting that. I don't know. I'm not in the predicting business. I read the market through the lens of auction market concepts. I get fooled just as much as anyone else, but I do know what the triggers are from the auction market perspective in an if-then scenario. So if we're seeing a sudden expansion in breadth, which we'd have to see if this is going higher, then this market can go a lot higher immediately in next week. And when I say a lot higher, I'm talking about 2 or 3% before we start to get more two-sided trade. But we shall see. All right, that's the NDX. Let's look at the Dow. The Dow had been lagging a little bit, but it now has joined the party, and we're trading in new all-time high ground. This was one of the hooks last week. We traded down into this level, and it looked like the Dow was on the edge of the abyss and was about to collapse. Well, it didn't, and now it has joined the party. Now, the laggard is our friend, Mr. Russell. The Russell 2000, it's 2,000 stocks, and it has been lagging woefully in terms of performance since the euphoric ramp into the December 27th high. It's suffered the biggest retracement, which was, that's very healthy, and 8% plus retracement. Now, this is where you can make a very bullish case or a very bearish case. You're simply not going to have a ripping bull market without participation in the Russell. Now, the Russell may lag, but it's going to be moving in the same direction as even the NDX. I've never seen, in my 38 years of trading, I've never seen it work otherwise. You're not going to have a declining Russell and an advancing NDX, SPX, or Dow. Not for long. You may intraday, you may for a day or two, but on an intermediate term basis, if we are in this ripping bull market that's going higher all year, you're going to see participation by the Russell. Now, the fact that it rallied on Wednesday, it closed on its high, even though it underperformed the other three, this is still a net positive because it did close on its high. So we shall see. Now, another way of looking at this is through the technical stuff that we keep. Now, I keep very, very simple things. I don't use oscillators, magic numbers, Fibonacci, Elliott wave, Gann, et cetera, et cetera, et cetera. I use NYSE data because it's auction market data. It's actual information about what trading is doing, what traders are doing, buying and selling. So the red is a 10-day moving average of NYSE advancing issues. The green that you see down here line is a 5-day moving average. The histogram is breadth, NYSE closing breadth. Now, a couple of things about this chart. We never got down to an extreme in the 10-day or the 5-day, but we got down to a level that we had not seen since last fall. Okay, so this was the lowest level that we'd seen since last fall. Now, this is turned up. I have learned from experience that you really don't want to fight the slope of the 10-day and the 5-day, in particular, the 10-day moving average. Obviously, it's 10 days average. Now, you can make a very bullish case here. I can make a bearish case here. The bullish case is there's a lot of upside here before the 10-day moving average were to approach anything extreme that would indicate a full boat. Nothing extreme, okay? Also, breadth. Breadth has been positive now 2 consecutive days, barely positive 2 consecutive days. On Thursday, it was just marginally positive. In bull runs, you will typically get clusters of days of positive breadth, and that will fuel the market higher. And your down days are relatively rare, and they're immediately retraced. Well, this is only 2. Now, we had at the end of the year last year, we had 4 into this top. So if we're going higher next week, we should continue to see expansion in breadth. We should see these moving averages creep up. We should also see the Russell participate, because obviously the Russell, being 2,000 stocks, is the index that is most sensitive and most highly correlated with NYSE data. Even though it's 2,000 stocks and they're smaller stocks, that index is by far the most highly correlated with this information. So that's sort of where we are. Let's take one quick look at the profile view of this. And I want to show, everybody wants to know, where are we going to stop? How high is the market going to go? I don't play that game. Nobody knows. The macro people don't know. The technical people don't know. Everybody's guessing. What I can tell you, though, is that, and you can go back and look at the weekly updates that I started doing in December, and I said, okay, You're going to have a more rotational market sooner rather than later. And if you look, that is exactly what happened. That began the end of December, a far more rotational market. Now I'm going to split this back out. And well, that's not what I wanted to do. Okay, so this is the daily profile. Okay, what you see here, each letter is 1 day of trade. Now you have within this, and this, this is this is chronologically defined by 1 month, but an auction is dynamic, and you have to be careful about trying to put the auction in a chronological box because it doesn't always tell you exactly where you are in terms of market condition. Now, if we split this out, and I'm going to split it from, see if I can get this nailed. Well, close enough. Okay. All right. So here you go. Perfect. So I think a new distribution, which is an auction range, began at Wednesday's low. So this is a new auction, okay? And if we're going to put it into what type of auction it could be within the confines, the constraints of the January auction, okay? So this is the low here. This is Wednesday's low. This is straight up. This is potentially a new distribution auction range. What you're going to get eventually, if we're going higher, now this is if we're going higher, what you're going to get at some point, let me get so let's say we go up into Wednesday or something like that. We go up some more. Then what you're eventually going to do, you're going to end up with this, but it may not occur until up in here, okay? Now, so what that might mean is you get what in market profile parlance is a double distribution. Let me find, here we go, where you have this run like this, and then you have this area in here. So, and I'm just guessing, okay. And then you distribute around it. And that's exactly what happened here. You had a double distribution in December. So we could be doing another one of these double distribution like profiles, but you don't want to get too hung up on stuff like that. I'm just trying to visualize how this market might form. You can predict the steps of an auction. The steps of an auction always occur. There's a step 1, a step 2, and a step 3. It's immutable. It always occurs. If you can show me an example when it didn't occur, send it to me, and I'll give you full credit. I'll post it and give you total attribution. But there's this very clear 3-step process that is occurring in market development in all degrees of time all the time, and that is something that is predictable. Now it's loosely predictable, and it's not always tradable, even though it's predictable, but it is predictable, and we saw that in December. I mean, when the market went straight up beginning in the middle of December, I said, okay, we may go a lot higher, but we're not going to go higher at this rate of change. And so what we've seen really for the past month is this whippy, choppy, two-sided market that has occurred in here, as opposed to this straight up ramp that occurred off the October low. So we are in some phase of that now. We'll see where it ends. I think next week, as usual, is going to be very interesting. I think it's sort of binary. I think, the normal would be we had so much momentum that you would see higher prices immediately. And then the trend would slow down. We wouldn't have the enormous up wide range days, day after day after day. That would be typical with this much momentum. On the other hand, you have to be alert to the reality that there's an extraordinary divergence between 3 of the 4 primary U.S. trading indices trading at all-time highs, with the Russell lagging so badly. Now, the bullish case there again is the Russell is going to catch up. So we shall see. You guys enjoy your weekend, and I'll speak with you again soon.